Hi, this is Brad Olson with Oaktree Financial Services. I hope everyone's doing well today. This is our quarterly update we do on the economy, a little bit about what's going on in the financial world to keep everyone informed, especially in these volatile and interesting times that we live in, which we seem that we've been living in for quite a while now. But it does affect the day-to-day situations we see in the markets. Again, to always reinforce, we do look at things on a longer term basis than day to day. So we have to always control emotion. But that's really the concept behind this quarterly briefing, is to make sure that you have a good handle on kind of where we're at in our thought processes. Now, your questions are always welcome. So feel free, if you do have any questions, there is a spot where you can ask questions. So if you go to the Q&A section, you can actually put in questions. So we always welcome so feel free to type in your questions. It should be on the bottom of your screen. You have that ability to do that. Now, as we go forward, one of the things I want to do is really kind of go over a little bit of the year-end report, just to briefly put 2021 to bed here in a couple seconds of what happened, but then really focus on where things are going forward. Overall, market performance was very solid for this last year. We were actually quite surprised. Basically, the pandemic situation did pause long enough before we kind of restarted to allow us to see that the economy did start to fill in some of the gaps we had in inventories and some of those things. Still got a long ways to go, but we did see that it did allow our earnings and our GDP to increase at a rate that did allow the markets to be quite kind to a lot of the equities. Plus, too, with interest rates being as low as they were, it was really the spot of choice when you looked at equity earnings from a standpoint of dividends and interest as we go forward. We're going to talk a lot today about some detailed things. I'm going to try to keep it at a high level to make sure that we're just kind of hitting the high points. But if you ever want to go into this in more detail, feel free to let us know. And again, we do value your questions. Just to always let people know, we do record this, and then we have the ability to get that out to people that didn't have a chance to join us today. So if you know anyone that would be interested in seeing this, feel free to let them know. If you want to watch it again, we will have that available, and he does make that available. So I want to thank you for attending before we get into things. Some keys is, you know where we're at. If you'd ever like to come in and sit down, feel free to give us a call. Again, we're updating the portfolios on an ongoing basis, but always are more than excited to talk about kind of where we're at and what the economy is doing. So if we haven't done our annual or quarterly or semi-annual review that we do with everyone, feel free to give us a call. And in the meantime, we can give you updates. Some things we're going to look at is, first of all, talk about kind of the goals of the meeting today. One of the things that we're doing here at Oaktree Financial Services is kind of our goals is keeping you fully informed. That's a big part of what we do. But we don't want to give you too much information. As I always say when I'm dealing with clients or even people that are looking at possibly using us for their investment and financial planning, is let us know how detailed you want to get. We get into a lot of detail behind the scenes, but honestly, I have clients that just say to me, again, I don't want to know how the watch is built, just want to know what time it is. So let us know if that's the theory that you have, and we're more than happy to make sure that we identify to communicate the way you want to be communicated to. So that data is very important that we understand that. Some things that we're looking at updating that you'll see on your highlights is on the slide on part B. You're updating your beneficiaries. We always want to make sure that we have the most up-to-date beneficiary information. So it's something that you're thinking about and something has changed, let's make sure we're talking about that. We always want to make sure we have a trusted contact. One of the things we're finding is as we all age, things change, and we want to make sure that if there's a reason we need to communicate, we can't get in touch with you, that we have a contact that we can work through to make sure that that communication process is there. Another area that we're doing is spending a lot of time on making sure that we have if you're taking money out of your account on an ongoing basis, or even not on an ongoing basis, but think you may do it in the future, we want to make sure we have your bank information linked, so it allows us to do that very efficiently without any delay in that process. We are spending a lot of time right now doing client review meetings. Again, we have a cycle of that we go through. If you'd like to see us before we have a chance to set up your meeting, due to the fact that we have it on I've asked people over the years We either meet quarterly, semi-annually, or annually, depending on what your preference is. We can do that via phone, we can do that via Zoom, or we can do that face-to-face, which a lot of people do. But it is a very important process that we make sure that we understand where you're at, you understand what we're looking at overall the business cycle, the economy, and also we're spending a lot of time on financial planning. And David will talk about that a little bit at the end of the meeting. First of all, let's get started. A little recap of 2014. And again, I'm not going to spend a lot of time on this information. This is rear view window stuff right now. So we want to make sure that we're not spending too much time doing it. But you can see the returns have been quite nice. You look at last year, the Dow 20.9, the NASDAQ 22.2, and the S&P at 28.7. You can see what the average return per year for 3 years and 5 years was. These are some fantastic returns. Now, this also inflates some of the ratios too. As you've seen these returns, we've seen stock prices come up to a level in certain stocks. And again, remember, when we're talking about averages, it's not every stock in the average went up these rates. You have some that did not and some that did. For example, in the S&P 500, it was heavily weighted by certain sectors in that 28% return that you saw. Same thing with the 3 and the 5 year numbers. So we need to be cautious when we're looking at averages. And I think sometimes we get kind of enamored with these numbers, but it has been a great return. If you look at a 3-year period, the S&P, your money's up about 84%, if I remember right. I think for 5 years, it's up 112% if you were invested in the risk of the S&P 500, which is all stocks and is very volatile. And that volatility is doing nothing but increasing as we watch the VIX, which is an index that talks about volatility. Now, I did want to highlight on the bottom of this slide a little bit what's going on with the Treasury. When you're looking at the Treasury, it is something that it is an important area from the standpoint of, you look at here, I'm just going to highlight this quick. You can see what happens is, you can see what the 1 year rate was at the beginning. Basically, we went last year from 0.93 on the 10-year to 1.52. Now you can see what it was back 3 years ago and what it was back 5 years ago. So there's no doubt this interest rate environment has been very conducive to an accelerated economy. And the Fed has purposely does that. And then when we had the virus, it even took that in a longer period of time and looked at it to make sure that we're keeping interest rates low to make sure we were coming back. This is going to stop, and I'll talk a little bit about that as we go forward. But it is something that I do want people to be aware of, is the fact that we are seeing some of these increases when we look at what's happening on the fixed income market. Because what this does is, just to jump ahead here, you are going to see that this does affect your bond holdings. So we always need to be cautious about that from the standpoint of making sure that when we're looking at this, that these situations that we're highlighting are going to be, how is it going to affect your fixed income side when we're looking at the interest rates going up on bonds. So it is something, even though this is historical, it is very prevalent when we go in the future when we're talking about this, because we are talking about, the 10-year going up to maybe a standpoint of 2.5%, which would be a pretty big increase if we had that much, as the Fed is talking about 3 interest rate rises over the next year. Let me get out of here. If we go to the next slide, what we see is, now here are some disclaimers. I'm not going to spend a lot of time on these disclaimers. If I read all these, we'd be here till next Christmas. But we do have to make sure that we are divulging where I'm getting a lot of this data. So anyway, that's what that is, just for your information. So let's get to some things. The last thing on 2021, and Andy put this together, just some highlights of what a year it was. From the beginning of the year, we ended up changing administrations. Bucks win the championship, which is quite exciting. I put that in the real positive standpoint. But just some of the areas that we had, down to the Waukesha parade attack, and just a lot of big things in our area, especially, that happened. Now, what happens is, I mentioned here inflation, 40-year high. These are things that do affect what goes on in our world. Although they don't dictate the markets per se, they do cause a lot of volatility. And this is nothing new. Again, it's the world keeps turning, and this has been happening for a long, long time, and we'll have the same things this year. Now, the question is, when we look at 2022, what will be the things that will fill in this chart? Is there going to be Putin? Is there going to be some things with China? I mean, what are the areas that can make a difference in what we're doing from an investing standpoint? And they're always going to be there. It's what the world does. It keeps turning from that standpoint. I always talk about the business cycle. Just and again, if you've been with us a while, you'll get tired of seeing these charts. But we look at where we're at in a cycle, and I'll talk about this. Basically what happens is that, to me, it was one of the areas some 25, 30 years ago that I identified that gave me factual thoughts on where markets were going, to try to take as much emotion out as we can, trying to take out a lot of the noise and really focus on what the business cycle is telling us between leading, lagging, and coincident indicators. What are they filling in? I mean, what are those, all these numbers that we talk about, how is that affecting where we're at in the business cycle? Because again, if you want to simplify this, interest rates and earnings are the two major parts of what we look at when if you want to look at a very broad stance, because interest rates are going to tell you where the Fed is from an inflation, from an overall standpoint on slowing or speeding the economy, and earnings are going to tell us how the companies are digesting what's going on in the economy. I mean, and that's what it ends up is we buy and sell things, and we were buying and selling those things. That ends up in profits, hopefully, for companies and helps their stocks. So the business cycle is a very important part of what we do. Now, I'm going to spend the rest of the time, and I pulled out a Joe Friday illustration here for us aged people that remember this. If I was doing this with the 20 to 40-year-old age demographics, they probably would have no clue who Joe Friday was. But we're really just going to talk about the facts today and really try to center in on some key points. Now, what I want to do is I'm going to go through quite a bit of information here, but just to let you know, with this information, there's going to be what is the key point. And I'm going to try to identify that fairly quickly and not go over every part of this chart. But what this does show us is basically the first thing I'm highlighting here is what's going on with the whole concept of what's going on with COVID. When you look at what we're seeing is we are seeing, again, we did see a decrease when we looked at towards the end of last year, that all of a sudden with a new variant, we saw a pretty big increase. So what that meant is we did see kind of a change and now, excuse me, for example, David and I were talking early this morning, and I didn't see this on the news, but he informed me that, for example, he had heard that Milwaukee is going to require masks. So every place you go, you're going to have to be masked in the city of Milwaukee. I'm not quite sure of when that starts or the details about it, but we are seeing that this has not gone away by any means. Now, the good news is when you look at fatalities, which I guess in a very crude way is kind of the bottom line to this, is we have seen that there hasn't been a huge spike from the standpoint of fatalities. I leave up to you how you feel about COVID. That, again, to me, it's a lot like talking about politics. There's a lot of different views on how this should be handled. I mean, I'm sure we'll all agree that, people get sick and people die, and that is part of this formula. That is quite sad. But also we have to look at what is it doing to our economy, which is really the area that we take when we look at it is what is this doing to our overall economy as we go forward. Now, also we are seeing when you look at overall, there is a progress towards immunity. What that means is we are seeing that overall about 90% of the people are either vaccinated, been infected and vaccinated, or infected only. And you can see that these numbers, I mean, and this is, I guess, going back to the original start of this, there was a lot of talk about herd immunity. Eventually, maybe we will have some ability, again, not to eliminate it. I think that was something that we were a bit mistaken from the beginning that we would do that. But what it does do is it does make it so we can reopen our economy. And when is that going to happen? Now, it's a little scary that we're actually kind of seeing it go a little bit the other way right now with a lot of the political and remedies that we're taking to make sure that this is shut down. Again, not saying it's bad or good. It's just what it's doing is it will cause the labor market and some of these other things to change. So this is a very important chart. I don't want to undersell this. So what's the key point on this chart? Is COVID is still here. It is still a big part of our economy that we have to figure out what we're going to do going forward. Now, next, I want to look a little bit at federal finances. Just to let you know, I mean, again, we're spending a lot of money when it comes to the standpoint of our total debt that we have, everything else. So when you look at it, when we go, and again, I'm not going to spend a lot of time on this, but what happens is when you're looking at how we spend our money, where do we have money coming in from? First of all, income, corporate taxes, Social Security taxes we take out, other. So in the borrowing that we have to do, what you saw in 2022, they're estimating a 22% borrowing or 21% that we have to do. So if you look at right here, let me just get my annotation here quickly so I can highlight that. You're looking at basically right here, this is what we're talking about additional we have to borrow to meet all the things that we're doing here. So you look at Medicare, Social Security, defense, non-defense spending, net interest, which is a growing part of what we do when this number grows. So overall, we are seeing that we need to make sure that the debt is not going to gobble us up from the standpoint of, especially when you start looking at these things. So it is something that is a part of the economy that we do have to balance between what we bring in and what we send out. But we are seeing, if you look at overall, when you look at some of the numbers as far as how much of our GDP, we are looking at, again, we went in for quite a long period of time here where our percentage of debt to GDP was relatively under control. Now we've seen that actually increase when you get up here, when you look at the forecast, we've seen it go up. Now it's not as bad as it once was when we were back here. You look at some of these areas when we were looking at areas that we needed to address very quickly, we're increasing spending quite dramatically. But it is something long-term that it is a fear that we're going to get up to 106% in 2031 of our percentage of GDP. So it is, so debt is not gone away. And my point is with this is, and what's the key point? It's something that our political bodies and the Fed does have to pay attention to. So the question is, can you accelerate your economy enough to make all the other parts work? Now, this does not include some of the stuff that we're proposing. If that stuff all comes in, it changes this math even more if we were to pass the Build Back Better Act. But these are areas that we do need to pay attention to as we go forward. Let me just erase this quick. So it gives you an idea overall where we're at from the standpoint of the budget side. So overall, you can see where we're at there. Now, when you look at our economic growth and the composition of GDP, gives you an idea. Now, this is one thing I do want you to understand, because it does make a point I'm going to talk about a little more in depth later on, is 68% of our component of our GDP is consumer spending, consumer consumption. So what happens is when you're looking at it, the consumer is a big driver of what's going on. I do have some fears when I get into that of what's going to happen with the consumer. So, the U.S. economy we have seen has rebounded. You can see by this trend of growth, the recovery right here. This was tough when you look at what happened, but we have recovered from a large standpoint. Now, what we're seeing is after the slowdown that we had at the end of 21, how are we going to reopen? What are the inventories? How are we going to increase our inventories? And are we going to continue to need to increase inventories as much as we have? So that's a key part of what we're looking at. So the key point is here is that we have recovered to a large degree when we look at our GDP growth year over year. The problem is it going to be sustainable to allow us from the standpoint of being able to see stock prices, which are a big part of how stock prices go up, is how are we increasing our buying from these companies? How are we increasing our expenditures? So that is something that we do have to look at. So that really is a very key point as we go forward. Another area is unemployment and wages. Unemployment has fallen as we look at the black number right here. Let me get my annotation again here to show you that. So when you look at it right here, you can see, we peaked in April of 2020 at 14.8% when we saw what happened with inflation, with unemployment. So that was our unemployment. Now you can see we have come down quite a bit. So that's good news. That is a positive that we've had. Now we still have, you're still looking at, a higher unemployment that we would like. Unemployment to fall below 4%, really, we're going to see that happen, for a period of time, we may see around that 4% rate once, especially with the pandemic and getting people back in the workforce. So that is an important part. So, but also I want to highlight the blue area here that does show that wage growth has been there. So we have seen that wage growth has come back from the standpoint of increasing wages. Now, what happens when you look at higher cost workers, that's really due to a labor supply, whether it be due to people not working because of the pandemic. And another part of the world that we always, and again, we've been talking about this for literally decades, is as the baby boomers leave the workplace, we do have a worker shortage, just a fact of life. And that's why it's so frustrating. And I will make a political comment here. I would love to see immigration be handled in the right way by both sides, because what happens, we can use the workforce in the right way. I think it's one that's handled correctly, and that's been the history of our country over the years. But we are going to see continued pressure on wages. One, because of the pandemic, getting people back in the workforce, less workers makes a big difference, and that does drive wages up, which does drive some of the other subjects I'll talk about, which is inflation in just a second. So these are areas that we do need to make sure as we're looking at this is how are we going to control our wage growth, and how is that going to affect our unemployment in a longer term basis. So the key point here is good news. Unemployment is coming down well below the 50-year average. Wage growth is increasing, which is exciting. So it is one where that part of it should help if, again, it doesn't aid inflation in a big way. It doesn't add to inflation. Now, if we look at sources of earnings per share, I did want to highlight a little bit about what we're seeing, where companies are getting their earnings. And you can see, for example, in 2021, a lot of that came from margin on their investments that they made. Basically, they had a margin. Increases in revenue that we saw, 16.9%. So when you look at it, companies were much more efficient from the standpoint of seeing their earnings per share growth. When you look at it, where was it coming from? So when we look at earnings have recovered spectacularly since the decline in 2020, and that really reflects stellar profits from most of the sectors. Most generally, earnings have been bolstered by consumer demand, higher productivity. The virtual environment to a degree has helped, and higher wages have slowed things down a little bit from a profitability standpoint, how that's going to affect it going forward. So the key point is we did have a great increase. Now, what that's done is it has increased our earnings per share quite a bit. Now, so the key here is we want to make sure that the pricing of companies doesn't go too high. Next, inflation. This is a very important area when we're talking about it. I don't know if anybody's bought a used car in the last year, but basically used cars went up 37% over the last year. So when you look at it, excuse me, much of our increase in inflation has been driven by things like that. A lot of the consumer goods have increased dramatically. We have seen oil prices increase dramatically, which works its way back into pricing. So when you look at inflation, the question is what's going to happen to it? I mean, we had the supply chain breakdown, which drove up prices, wages rising. Basically, right now, oil prices are the highest they've been since 2014. And again, whether you agree or disagree, I mean, the policy that we took coming into this administration was to address the climate change in a fairly active way. And what that did do is it did drive production in a different way. Now we are much more dependent on some of the foreign sources, which when you look at it are much more not in our control. I mean, we cannot control what's happening with OPEC and some of the other ways that we get energy. So the question is, what is going to be that transition plan? And that is an area that when we look at it, we kind of wonder how that's going to shake out. So the question is, what's going to happen with inflation? Now, as we go forward, it's not going to stay at the 7% that it was. I mean, that's the highest again in 40 years that we've seen, back to 82. And for us of a certain age, we remember what that was like. Tried getting a mortgage at that time and find out what they were. We don't see us going back to those levels by any means. But my thought is, and a lot of the stuff I've been reading, I could see us settling in around that 3.5% range for a while. And again, depending on what happens with the energy prices, what are we going to see at the pump? Are we going to see the average right now is 331 331 on a national average. There's a lot of predictions. We're going to see that by May, June-ish area go up to the $4 range. If that happens, that does put a lot of pressure on a lot of consumers. And what it does in the area that I've always, looked at when I'm talking about inflation is what does it do to not, if you've got a decent account, and I think with a lot of our clients, we're very happy with the dollar amounts we've accumulated over the years. But honestly, for the working person that's not making a ton of money, gas prices, oil prices, natural gas prices, those things are devastating when they go up that amount. All of a sudden, instead of spending $50 to fill up, you're spending $100. It makes a big difference. So these are areas that no one knows right now, by the way. I was reading the Barron's that came out this weekend, which I was reading on a pretty detailed basis. And it's basically 22 predictions, the 2022 predictions by some top asset managers. They're all over the board. I mean, there's such a variation on what they feel is going to have with inflation. Again, my theory, or what kind of the consensus I've looked at, I'm thinking we settle around 3.5% for 22, which is higher than we've been, which will be facilitated by rising interest rates. So the key point here is, where will inflation go and what will it affect from the standpoint of what you have left in your pocket to spend? Because one of the areas right now that's also a big worry, I am seeing that consumers are spending a lot of their disposable income. So even though they went from $15 to $20 an hour, they are spending a lot of that money because of inflation. So people feel like they have more money, and the consumer is still putting out quite a bit of money. But the question is going to be going forward is, how is that going to balance? Because my worry is someday somebody wakes up and says, boy, I don't have what I thought I had. And we start to see interest rates rise and maybe start slowing down our GDP a little bit. What happens when we start filling inventories? No longer we need to fill inventories as actively as we were because the shelves were bare. Because right now the shelves are still bare. We still have supply chain jam ups in the port. We just moved the ships farther off the coast. So they're still there. They're not totally gone yet. So what we're seeing is we're seeing that this is a key item of what it's going to do to the average person as we go forward. Fed interest rates, bottom line here is rates are going up. The Fed has already made their decisions to do what they're going to do as far as raising more money. You are going to see that basically, or I shouldn't say raising more money, taking money out of the economy. They basically, the purchasing they do to put money back in the economy, they're slowing that down. They're talking about 3 interest rates next year. This was a chart I took off of JP Morgan that basically says that interest rates basically could go up to about 2.5%. So what we're seeing is, we're seeing that overall, that's kind of where we're at. So the kind of the key point there is we do have to figure out where interest rates are going, because that will slow down the economy, and what's happening with inflation. Valuations, not going to spend a lot of time on this. The bottom line here is that we are seeing that right here when you look at the overall concept of, right here is the key, that we are seeing that price to earnings ratios, and this is on the S&P 500 when we're looking forward, are a bit high. When you look at the average, a 25-year average is 16.83. What, again, that means is for every dollar that a company makes, how many times is their stock price times that dollar? So you're looking at 21, almost, a little over 21 is where we're at right now. Where is that going to go going forward? Are we going to see that come down? Because either stock prices come down or earnings go up. That's what affects that ratio. Now, we have seen, for example, over the last few years, a lot of the growth stocks have very high PE ratios. The Microsofts, the Apples, some of those. Now, are those going to come back more into line? And that's where, going forward, again, not to steal my thunder here, you're going to see that stock picking is going to be a lot more important than just the dartboard effect. I mean, you're going to have to be looking at things that have good valuations that you want to take advantage of going forward. So it gives you an idea there. Let's go to the next slide here. International equities, last point I want to make here is we are going to see that international equities, we think, could be a standpoint of being able to give us some advantages as we go forward. You look at some of these PE ratios on some of the international stuff, what we find is they're actually, when we look at US, we look at Europe, Japan, emerging markets, China, we think that there's some good opportunities in some of these markets going forward. Once we see the virus start to settle in a little bit, I think we're going to start to see the world open up a little bit more, and it should allow us to see some of the standpoint of international equities increasing. So key point here is we like the valuations. We're looking at putting a little bit more of that in the portfolio as we go forward. Again, I talked a little bit about this as far as where we're at from a standpoint of P&E ratios. It is something that from a valuation standpoint, we have seen it very wide. So we've seen the valuations compared to the PEs get quite high. And so we've seen that this is volatility. We've seen a lot of volatility. So the key point is going forward, we're going to see a lot of volatility with what's happening. We look at 2-second stretch. Well, we don't have a lot of time to stretch here. I'm sitting at about a half hour, and I'm going to keep this to about 45 minutes, and David's got some stuff to go through. So quick dog stretch, and we'll move forward here. What happens is I just wanted to do a little bit of summary growth in the fourth quarter, what we saw that it revealed. We saw that the fourth quarter was down sharply from earlier in the year, and that a lot of it was going on with the situation of the COVID and where things were at. Consumer spending, we did see it decelerate a little bit at the end of this year, last year, pick up again. We're starting to see a little bit of that. Supply chain definitely impacted. We talked about weaker auto sales just due to the fact that we couldn't get cars, couldn't get chips. But the growth is not all gloom and doom. We still have a lot of inventories to fill. The shelves are still low. Consumers are spending. So the importance of this is, from a growth standpoint, we are not discouraged from a growth standpoint. We are seeing that it may not be, it's not going to be the massive rates it has been with our GDP growth, but we do see it probably being a decent, solid standpoint. But there are some things that could be headwinds too. We look at jobs. We saw the job market. I mentioned a little bit about that. We saw that increase. We saw us bring unemployment down. We saw wages increase. But this one right here, when we do look at what's going on with the virus, I mean, that can disrupt our supply very quickly. So these labor shortages have been making a difference. And it does drive inflation. So important point here is people getting back in the workforce. And us being able to support from a company standpoint, as long as the demand's there, we can support wages and we can see that increase. Inflation, I talked a little bit about that. I'm not going to go through this one in a lot of detail, but I do want you to understand that this is going to be a key item in 2022. We don't know where it's going to end up. Is it going to end up 3.5? Is it going to stay at this higher level? How much wage increase? Now, we're looking at, for example, I talked about oil. I mean, that can make a big difference. I mean, some of these numbers leave out oil and food because they're so volatile. I've never bought that completely. I think we always should talk about energy as part of our inflation. It's just, it is volatile to a large degree. But when you look at it, it does make a big difference. So what is the Fed going to do to control inflation? We already seen. Take the quantitative easing down, and also what they're doing is raising interest rates. So what does this do to your portfolio? We need to make sure we're positioned for that. Earnings, fourth quarter, what they revealed going into this year, that companies are still making money. Cost in energy and labor went up. These are things that could affect it. We don't see, again, a shutdown in 2022, but there will be a lot of volatility because remember, 70% of what we make from a GDP standpoint, our gross domestic product, is done by the consumer. So what is the consumer going to want to buy as we go forward? So that rates, I talked a little bit about them. They're taking a much more, is inflation transitory? I think it's a mixed question. Is it transitory? A little bit of it, yes. There is some stuff that is going to be transitory. Excuse me, but there is some things that are going to be more permanent when you see it looking at inflation. Overall economy, consumers are spending more. They represent 70%. My worry is they're spending too much. And will that slow things down too much as we go forward? So watch consumer sentiment. Watch how the consumer's feeling. We get into election. It gets very negative. How are consumers going to feel? I mentioned where we're at in the business cycle. When you look at it, we're coming down. And again, this can happen very quickly where we can be coming up too. So I don't want to paint this that emotionally, I don't want you to feel that things are gloom and doom here. I do see that we do have some opportunities that we need to get by. We need to make sure that we're controlling inflation, because if that gets out of control, it's a different ballgame. Summary of some risks: further COVID, that can affect things. Inflation, I talked about that. And the Fed removing, I mean, this has been a sugar high from a money standpoint, no question about it. We've been putting money in a system that we've never seen before. That has helped keep this going the way it is. What happens when we start pulling back? I mean, we feel that we need to be a little bit more cautious from the standpoint of our portfolios, just to make sure that we're controlling that. U.S. equity investors may use earnings as a guide. I mean, that's one of the things we're going to be looking at. Fixed income investors, we have to watch that very closely. And I'm trying to take action to make sure the fixed income stuff you're in is going to not be totally decimated by rising interest rates. And that's where we have to watch that. Falling dollar and cyclicality support international equities. I talked about that. I think that's an area where we can have some advantages. So there is places we can go. Again, I am doing it in caution because, again, most of our clients, we're trying to preserve. We want to grow, but we want to preserve. You don't want to be down the 56% the S&P was down from 2007 to 2009. I talk about the S&P all the time. Remember, 56% 2007 to 2009. You don't want that. Some things we're looking at: inventory correction. We need to get that corrected, inflation, and what that's going to do to manufacturing. I've talked here for about 35 minutes. I want to spend about 5 to 10 minutes having David go over a little bit about principles about investing from a standpoint of retirement. And we're dealing with a lot of people right now of doing that. So let me go ahead and assign this to David here. So he has the ability to panelist. Okay. So should make David the host. Hang on one second here. David, are you controlling things?
I don't believe that yet. Should be coming here.
Okay. Yeah, we have a little delay in when we switch computers here, so bear with us just a second. David's been with me for about 2.5 years now. Been in the business for a long time. Has a great standpoint on doing a lot of the financial planning. We use a program that he is very good at using. So want to make sure that he has a chance to highlight that. Go ahead, David.
Great. Thanks, Brad. So a lot of the focus that we have here at Oaktree is really just helping you successfully navigate the journey of retirement. And there's really kind of, as you see on the screen, 7 basic principles that we are addressing, that we help you consider when you're planning. And I'll quickly just highlight those. We're wanting to help you in creating a plan that really just kind of paints the picture of what your retirement looks like. One of the things that we're seeing in point number 2 is just how many people are living well into their 90s. My father-in-law is there. A lot of some of our clients have that timeline as well. So when we're looking at planning for the long life, we're usually just putting together a plan that is looking at a minimum of 30 years for a lot of us. Social Security, number 3, that's a really a key for a lot of people. That's anywhere from 30 to 40% of their successful, the amounts that they're using for their income during their retirement years. So there's some key decisions that you want to be focused on. One of the things that we're talking about right now is, again, healthcare cost. Brad highlighted just the average cost going up. Right now, those are in that 6 to 7% inflationary rate on an annualized basis. Taxes, none of us like to pay more than is required. So we are constantly looking at how to make your portfolio, how to make your plan very tax efficient. And that's something that we review on a continuum. Protecting the short term. This recent volatility that we're experiencing, one of the things that we put together for our clients is kind of I'll call it a little bit of a bucket system. And so when I'm looking at developing a plan, I'm looking at monies needed for the first 1 to 3 years. And what that does is it just allows us as investors to really not worry, try to minimize or mitigate the concerns in regards to the market volatility. And number 7 is just really evaluating. Brad spent a good amount of time of some of the things that we're looking at. So being a very well diversified portfolio allows you then to remain invested for a successful retirement. So let's just drill down on a few of these to help you with your financial plan. And hopefully I can get my screen to move here. Apologize, had a little bit of a delay. Defining your goals. I guess one of the things that I would highlight, we're constantly asking, what is your goal? What's your future look like? What does that paint the picture for us? We're going to help you to become artists to kind of define what your goals look like for your future. What are some of the goals and aspirations? When will you be traveling? Defining your timelines. Again, when do those events take place? Is that happening within the first 5 years of your retirement? Is it happening on an ongoing basis? So assigning some timelines for each of your needs. Knowing your checkpoints. I'll describe it maybe this way as a progress report. Think of it when you're traveling and visiting family. A lot of us use MapQuest these days. And so MapQuest is kind of helping us determine where we're at, where we're going, and how we're progressing. Save during your retirement years. One of the things I would encourage, and we do encourage our clients that are saving for retirement, is to pay yourself first. And again, we try to encourage clients to save a minimum of 10% each year. And then as you're in your working years, as there's a pay increase, we're asking clients to pay yourself first and increase that with the ultimate goal of getting to a 15% savings rate going forward. And that those that follow that plan have definitely done well in regards to accomplishing their goals. So next screen, and I apologize here. Planning for a long life. Let's address that. I think what we're seeing right now is that is dramatically increasing. Again, I mentioned my father-in-law who's turning 92 this year. And again, the changes or the needs. So the longer you're living, from an investment standpoint, we certainly need that to last a long time. And so we anticipate some of the numbers reflecting that if you're planning to retire at age 65, for a lot of us, make that plan being out there to between 90 and 95 years old. Apologize. There we go. This screen just currently kind of identifies, if I look at this 2019, what we're seeing here is basically that the average person right now, average female, is living to 85.6 years. Us men, we're kind of closing the gap a little bit. We're up to 83, and again, we're just seeing that consistently change. Again, that's due to the great amount of improvement with medicine, and so the care that we're getting is just to help us to have a longer life expectancy. Doesn't always mean that it's the greatest of life, but again, we're here. So again, that's a factor that we have to plan for. There we go. One of the things about Social Security, one of the things that we're doing and focusing on is really helping clients determine, should I take Social Security? Is it beneficial for me to postpone and wait? You're certainly getting a benefit after your full retirement age, an annual increase each year of about an 8%. So some of our clients are postponing and waiting. Some of us, out of needs and necessity, are claiming at number 3 here, claiming at 62. One of the things that you have to consider is, how much have you saved in your current retirement plan through your employer or through your general savings? That's going to determine, again, how much. But if you're claiming your benefits, understand that you're going to be, and I think most of us know that we're receiving a lesser amount, and it can be as much as a 30% decline by taking that early claim of our Social Security benefits. What we're seeing here, and this is just kind of an illustrative, again, for the birth year 1960 and later, the benefit of getting this 8% per year gives us an increased benefit amount. And again, we'll help you as far as determining, whether or not you should consider taking it today or postponing it for future years. But there is a very strong financial benefit in waiting, since we're living so much longer. We do ask, we do address the questions also in regards to, is the likelihood of Social Security going to be here? In our estimation, for those that are retiring in the next 3 to 5 years, I think that's we can feel confident in that. Again, just more about Social Security. We don't have an easy way to determine, but again, we will help you. The second point here, it'd be easy if we knew when we're dying, but we obviously don't. So we want to just help you kind of take that into consideration, help you with make an informed decision as far as when you should take it. This screen here is just kind of an illustrative showing you what the amounts of claims, from the standpoint, if I'm claiming it at age 70, this example, $4,089 per month, you can see that it's a significant dollar amount. And so that's why it's such an important decision, for our clients as far as when they should claim their Social Security benefits, because it's a very significant number. And we'll again highlight that for you and help you make an informed decision. What do we expect from rising healthcare costs? We anticipate, again, the recent numbers reflect that healthcare costs are up 6 to 7% per annum. I've seen some studies that reflect that during your retirement years, your average expense in your retirement years is a range of $200,000 to $270,000 that you'll spend for just average expenses for healthcare. The other item that we highlight and look at significantly is the cost of long-term care. In the Milwaukee area, we're dealing with the average person in a full-scale program, nursing home. They're spending in excess of $100,000 per year for the care of a private home, a private care facility. And so that's a significant number. So it's one of the items that we do introduce in our conversations to determine how do I address that future need. And so again, we'll highlight that for you. Again, the assumed cost, the annual growth rates and healthcare costs, I just highlighted that's at 6%. So, and I don't see that obviously going down anytime soon. This is an example that just I'll quickly highlight. The average person is spending about $479 per month in regards to Medicare costs during their retirement years. You can see this next column here is, projected out, but again, it shows the effect of inflation. And so the average person is going to be spending $1,517, in 2051. And again, that's an estimation, as far as what the average costs are going forward. A significant number. So we just need to make sure that we're helping you plan accordingly for that. One of the things that Brad emphasizes, how do we help you minimize your taxes? We're not tax advisors. We're not licensed in that capacity, but we're looking at ways to help you offset that. And in the planning, am I deferring enough income? Am I taking advantage of tax-free or tax-advantaged different vehicles for savings? And again, we can help you look at the considerations. We do help in regards to looking at, do I convert the current money with today's so-called low tax rates? Do I transition that into a Roth IRA? So that's part of our conversations currently that we're doing, is trying to also make sure that it's as tax efficient. And again, this is an example of the benefits of converting part of your assets to a Roth and the amount of savings over the years, different stages in your life. Short term, basically, one of the last things I want to just kind of emphasize is, again, we're seeing recent volatility in the markets. Again, we look at trying to help you identify the first 1 to 3 years of your retirement income needs, and really just position that in a very conservative manner to cover your expenses, cover your emergencies, so that you're less concerned about what's happening on a daily basis on the markets. The last few days have been somewhat volatile, and so we just want to make sure that you're taking that off of your periphery and just kind of letting the planning for the current needs. And we do that with the plan. I would just highlight just quickly, I know we're running out of time, but I just want to emphasize, one of the things that we have tried to do, and it's been helpful for our clients, is really just taking a very balanced approach. So all this is really just identifying is, there's benefits of having monies both in equities and fixed income. The challenging part right now is that the low interest rates make it difficult, so we're having to expand a little bit of the equities. But again, over long terms, 20 years, as this pointing out, average return, has been around a 9% return with a 50-50 balanced portfolio. And so I think that's a strategy that we're continue to focus on. Help is available to you. Get help from us. Feel free to review things. We're going to help you put together a very tailored, diversified strategy that is for you. And we do pay close attention for your comfort level, your tolerance for risk, and how that impacts your returns when the market's going up, ascending. It takes some risk. People don't focus on that. So we just want to make sure that we just are not eliminating it, but that we're giving you the perspective of what the market's risk is at that time. Last screen here, we just again focused on just becoming very diversified, very tailored, specific to you, and just having exposure to the multiple areas of the market. That's something that will help you with. Stay invested. I'll leave it with that. One of the things that allows us to do when we're putting together a diversified plan is allows you to stay invested and not have dramatic swings of emotion. So the average person who stays invested historically just does a really a much better job overall return wise. And so we want to just help you stay invested for the long term, because your retirement is a good amount of time, again, 25 to 30 years. And so we need those positive returns long term. This is just a reflecting of, as far as staying invested, the difference. Maybe some of us are visual, but if I miss the best 10 days of the market from a recovery standpoint, I basically cut my return in half, and you do that multiple times. So it's just again, positive reinforcement for us to stay fully invested. And I'm just waiting for my.
Okay, thanks, David.
Very good. Thank you, Brad.
I just want to kind of get to a point here where we kind of summarize where we're at. First of all, anything we can do to help you. Here's the 4 advisors that we have in the office. Feel free to contact your advisor or contact us in any way we can. So anytime we need to meet. We covered a lot of information today. We went through, talked about inflation and all the different things. I mean, the part that David did, I just want to say thanks, David, for doing that. I know we went a little bit longer today than we usually do, but the whole retirement situation is one where we're spending a lot of time with people either that are retired or are going to be retiring, in making sure that we have a solid plan. I mean, we're doing a lot of financial planning right now with people to make sure that we're laying out your retirement, and it is your retirement. We need to listen. And I think one of the biggest sins in our industry is a lot of our industry doesn't listen. They throw out things that are kind of the axioms that have been there forever. We need to make sure that's personalized for what you're trying to do. And there's a lot of volatility that's happening right now. We just need to make sure that we're prepared for that. So these are some of the things that we're looking at as we go forward. Again, trying to keep this to a reasonable time. If you ever have anybody that wants to sit in on these, we're always looking for people who want to hear more about what's going on. Again, it's be very factual based. Back to the Joe Friday thing, I try to make this not emotional, try to make it factual, try not to make it political, try to make it factual. is where we're going forward. So we're always available for that. So let anybody know that they'd be interested in sitting down and going through and doing some planning, not investing, planning, because the planning will lead to the investing. That's very important as we're going forward, that you understand that. Because an investment portfolio without a plan is really not an investment portfolio. It's a very random event that's going to be very volatile and not meet your goals. So feel free to touch base. Last thing I want to do is we do have some questions. I'm just going to take a couple of them because we are now approaching an hour. So I'm going to kind of pull these up and read them quickly as we're going through this. How can the economy be called strong and growing with this level of inflation? The level of federal spending, the level of debt, the supply chain, all very true. And anybody who says they understand where things are going in 2022 or beyond do not know. All this is going to play out in real time. How the Fed handles it, I do know one of the key things was the Fed making sure that they did raise interest rates. Because if we wouldn't have done this, and another question I saw in here as I was reviewing them when David was talking, somebody asked, are we going back to the Jimmy Carter years? Don't perceive that in any way. We're not going to be back to the 18% inflation that we had with those interest rates at the level. We should not. Now, could that have happened? Yeah, if the Fed would have played Rip Van Winkle on raising interest rates much longer, I think it could have been a lot worse as we went forward. So it is important that as we're looking forward with this stuff, that it's not a given. Any of this stuff will play out. I mean, as I mentioned, we can have political things happen that can change things tomorrow. Let me just pick out one more question here to keep this to an hour. Okay. What changes, I guess is a good broad one to bring up. What changes should be considered in my portfolio to reflect my fear of economic weakness and future pain? And again, I do feel that a lot of people now we are seeing consumer sentiment start to change a little bit, where people are a lot more worried than they were. We need to make sure that we're adapting your portfolio to you, not to some general balance across the world. It needs to be to you. How do you handle risk? Now, there are areas that we can do to address that. We're looking at more investments and more planning that allow us to control as much as we can the risk in your portfolio. And there are some products right now that do allow us to do that. And we are looking more into those. So as we go forward, if you're very worried, you've met your goal, you don't need to push the envelope. It is time, and we're meeting your needs that you have, and that's important. Some people, we have to stretch a little bit more to meet their needs than other people. We need to make sure the portfolios are properly positioned for that. So a very good question. In general, equities that have good valuations, I think it's going to be more of a market of making sure it's just not going to be across the board. It's not going to be dominated by just a few holdings. We need to make sure that bonds are under control, making sure that the duration, the length of the bonds are not going to be affected too dramatically with interest rate rises. Looking at more of the international, monitoring COVID, monitoring inflation, monitoring supply chains, monitoring people going back to work. These are all important items. The last thing is I just want to say thank you for attending. I really enjoy the opportunity to do these, and I just flipped off the chart here. So I want to say, thank you for being here. It is one where we have this information. The question is, how much do you want to hear and how do you want to be communicated? I want to make sure we keep doing these from the standpoint of making sure that if you want to hear more about what's going on in the economy, we have it. And David's part, retirement income is a major focus of our clients right now and of us. So feel free to sit down and we can go through that. So thank you for your time. Feel free to follow up with any additional questions with your advisor, with me. We'd be more than happy to go into more detail. Thanks and have a great day.